Hey there, happy Sunday, dividend growth stock investors. Back again for the weekly Sunday video where I'm going to go over each of the 4 tiers that the DGI Crab channel focuses on. My name is Colby, the DGI Crab. I cover 60 stocks on this channel, split into 4 separate categories that are based on the age and time horizon of the investor, which, if you are a dividend growth stock investor, I strongly believe that is the most important metric you should take into consideration when it comes to what stocks you're investing in. Your age and your time horizon toward retirement. So here we are, April 13th. The Trump tariffs are causing massive swings in the market. Markets crashes, the market recovers, then it dips a little bit, then it goes up a little bit. What are things going to look like at the end of all of this? I have no idea. No one out there really does, not even Trump himself. None of the other quote unquote experts that are out there. We all have our opinions on what's going on with that. This is not a political show. I'm not here to praise Trump or bash Trump over these tariffs. I'm sure, just like with any other president, there's going to be some things that he does that turn out to be really good choices and some other things that he does that turn out to be massive mistakes. Every president has a few of each on their record. So we'll have to wait and see what these tariffs are going to do and how things are going to play out over the long haul. But all we can do right now, you guys, is look at the history of the high quality blue chip stocks that we cover here and see if we can find some value and hope for the best. So, I'm not a professional financial advisor. The content of the channel should be considered primarily for entertainment purposes. And if you are new to the channel, this is how I invest my money. Each and every week, I put half of my new investment dollars into age-appropriate ETFs. So I always have diversification no matter what individual single stocks I happen to be investing in. I am looking for stocks that are yielding at least 30% or more above their 4-year average yield, because I think that I'm getting a bargain on the passive income that I'm acquiring at that particular price. And then I do have a group, just my personal group of 10 favorite dividend stocks. If I only held 4, I put them in a top 10 list. If any of those 10 are yielding just 20% or more above the 4-year average yield, I will go ahead and add to my positions there. I would like those stocks ideally to be my 10 largest single stock positions by the time I hit retirement, or at the very least, 10 of those 10 stocks need to be in my top 20. Now, I'm going to remain within my tier unless there's a stock in a different tier than mine that's yielding 50% or more above the 4-year average yield. I've got, let's see here, still 5 of the 60 stocks here are yielding 50% or higher than their 4-year average yield. And if there's no viable stocks within my tier in that any given week, I will just double down on my ETFs and just go 100% that week into my ETFs. No problem there for me. So we're going to go to a spreadsheet here like we do and go through the stocks in the 4 tiers. We are sorting here by the valuation metric where I'm comparing the 4-year average yield to the current day yield to see how far off those two numbers happen to be. If they're in the green, they've hit that 30% or more undervalued. Yellow, 20 to 29.9%. Red, everything else. I'm a buy and hold investor, so even if I've got a stock that I think is currently overvalued right now based on that metric, like Centos or Broadcom, I'm not selling it. I'm just holding it, reinvesting the dividends, and focusing my new money on the positions that are trading cheap. Wow. The most undervalued stock throughout the history of this channel has been Nike. The very first video that I did on this channel last summer, where I went through each of the 4 tiers, Nike was looking very undervalued because the day before I launched that video was the day they crashed from 90 some odd dollars a share down into the 70s. And now, as a result of these tariffs, Nike has fallen even further. The tariffs specifically on Vietnam, where they do a lot of their manufacturing, could really have a major impact on Nike. But this is the largest shoe and sports apparel manufacturer on the planet. And so they have a very wide moat, plenty of products like your Jordans, your Air Force Ones. There's just a lot to like about Nike, the company. and their brand recognition. So I'm going to continue adding to my Nike position each and every week. I'm getting almost a 3% starting yield right now. I'm just going to keep bringing that average cost down. Nike's trading at levels it hasn't seen since like 2011, 2012. Um, if they cut their dividend, I will cut and run. But at least for right now, I don't see anything in the financials that would lead me to believe that they're going to cut their dividend. In fact, I hope they're going to be buying back stock aggressively at these particular prices because this is just too low, way too low. Loving Nordson down here. I thought Nordson was a great deal in the low 200s, sitting down here at 185 now. Industrials are taking a hit with these tariffs for sure. For your average yield, at just right at 1% for Nordson. You can get it at 1.68% right now. And that is a really great deal in my estimation. And then Analog Devices was in the buy zone last week. They're not quite there now. They recovered just a little bit. Lowe's is starting to look appealing also. I wouldn't turn my nose up at anyone adding stocks that are in this yellow category either. Great companies to have, and as I've said in previous weeks, Microsoft, one of my top 10 favorite stocks. If it's yielding, I don't even wait for the 20% mark with Microsoft. If its current yield is higher than the 4-year average, especially if I'm 30 or younger, I think it's a great idea to just keep adding to a Microsoft position, one of the safest bets on the entire stock market. Okay, so tier 2, the age 31 to 41-year-old investors, this group of stocks yields a bit higher than tier 1, grows a little bit slower year over year. Got 5 stocks in this category that look to be underpriced, with Target being the main dog of the category. 92% undervalued based on the 4-year average yield of 2.51%, currently yielding 4.83%. Really high yield to be able to reasonably grab here if you are in your 30s or early 40s. Usually you're going to be buying stuff in the 2 to 3% yield range here if you're doing it correctly. But hey, you can get 4.83% yield with Target right now. I think they'll navigate out of this trouble. I went to Target here locally last week to pick up a couple of things. The store's crowded. There's plenty of people going to Target, and anytime I happen to drive by that area, it always looks like there's plenty of cars in the parking lot. So I think Target is going to be just fine in the long run. They're just going through it right now. Still adding to my Hershey position, you guys. I've been preaching Hershey for a long time now, ever since it dipped down into like the 170 range. You can get it for 165 right now. Full percentage point higher, 2.13% 4-year average, 3.31% current day yield. Loving Hershey yielding this high above 3%. And then we've got NextEra Energy, Texas Instruments, and Starbucks all down here in the buy zone. And you can certainly keep a very close eye on American States Water. And McCormick again is starting to look a little bit interesting. I was adding McCormick last year, if you'll remember, when it was down in the low 70s. It recovered there for a little while, but it's looking like it's getting close to being a good viable stock again. And then Union Pacific, a top 10 stock for me. This one, 13% off the 4-year average. I'm keeping a very close look on this one, you guys, because if this one hits that 20% mark, I am jumping in on it. Tier 3, age 42 to 53-year-old investors. We got 5 more undervalued stocks in this group where the starting yield's getting a little bit higher. The overall dividend growth rate's slowing down a little bit. This group of stocks, lots of blue bloods here, plenty of dividend aristocrats and kings. Archer Daniels Midland has just been, performing terribly from a share price appreciation standpoint, all the way down here in the mid 40s. The yield well above 4%. And you can see here the 4-year average yield still just sitting here at 2.54%. So Archer Daniels Midland still looks really nice, really appealing here to me. Hormel's been down in the dumps forever, but if you've been adding Hormel in the low 30s, high 20s, you've been getting a really nice dividend yield in the high 3s. And that seems to be a pretty good deal for Hormel. Genuine Parts Company, I think these tariffs are really going to hit GPC depending on how they go. This one might even have further to fall if I were going to guess, but I like it here in the mid 110s. I'm going to keep adding if I'm in this particular category. T. Rowe Price, still yielding really high. 4-year average yield continues to creep up. So the longer it stays down here, the less appealing it's going to be. But 5.72% starting yield. You get paid a lot to wait for a recovery on that one, you guys. And then Pepsi, a top 10 favorite stock of mine, again, in the buy zone. Again, really excited to add Pepsi. And Johnson & Johnson's dipped back down here, too. Another of my top 10 favorites. Not quite at the threshold I want it, but if this goes down below 150, I'm back in on it, you guys. Let me know what you think about J&J. And then tier 4, age 54 and older investors. So look, this is starting to look better, actually. I know we've got all red here, no greens, no yellows, but we've got 1, 2, 3, 4, 5 stocks that have gotten above the 10% undervalued mark. So these stocks haven't been immune from the drops either. Nothing that if I'm 54 and older, am I going to jump into right now? I'm going to be sticking with my 54 and older tier 4 ETFs because if I'm 54 and older and still building income towards retirement, I'm not going to be risking a whole lot on individual single stocks if I don't think I'm getting a great deal on these because I don't have as much time to make any incorrect calculations. Nice group of stocks here, but I'm still waiting on all of them. Real quick, swing by the top 10 tab. All these stocks are somewhere in tiers 1, 2, or 3. Pepsi being the one that's in the buy zone right now with J&J and UNP getting close. Microsoft, good enough for me right now. Everything else, still a hold. What does the strategy look like for the week if you are in any of these tiers? Well, if I'm 18 to 30, I'm going to do half my money in ETFs. I'm going to allocate 25% to the S&P 500, 25% to a small cap, 5% to a dividend growth, and 5% to an international. VYMI is my 5% international investment all throughout the tiers. It's the only non-US stock holding that I have. If I'm in tier 2, I'm going to do dividend growth in VIG at 25%. With 15% in the S&P and 5% into small cap. For tier 3, SCHD, VYM, DHS, I'm going to spread it around amongst these three with the highest allocation going to SCHD and a little love here going to VYM and DHS. For tier 4, I'm doing an ETF double down. So ordinarily I'd be doing 15% into SPYD for my stock exposure and then doing 5% allocations into high yield bonds, preferred shares, MLPs, 3 different covered call ETFs. These are the cream of the crop here, if you ask me, Devo, JEPQ, and SPYI. But because there's nothing in that tier 4 category that looks viable on the single stocks, I'm doing a double down yet again, 30% and then 10s. And then I don't double down on international, so I'd actually be, if I'm in this 54 and older category, I'd put that extra 5% left over into T. Rowe Price. Heck, I'm getting that 5.7% starting yield. That's a higher starting yield than I'm typically going to get with SPYD, so why the heck not? Now, for the tiers 1 through 3, if I wanted to hit all of them, I'd probably balance it out like this. I'd hit Nike pretty hard with 15% of that money. Nordson at 10%, so I'm getting my 2 stocks in tier 1 that are in the buy zone. I'm going to add money to Microsoft, and I'm going to hit Pepsi, Target, Hershey, ADM. 50% or more undervalued on these 3, and then Pepsi, one of my top 10 favorites in the buy zone. That's my allocation for tier 1. For tier 2, really spreading the love around. I'm doing 10% into Target. And then 5s down the board here. I'm doing 5 into Hershey, NextEra, Starbucks, Texan. That covers me for tier 2. Then I get my top 10 favorite in Pepsi, and I get my 50% or more undervalued from the other tiers, ADM, Nike, Nordson. And then for tier 3, Pepsi and ADM are going to be the highest allocations for me. And then I'm going to finish off within my own tier with Hormel, GPC, and T. Rowe. And then my 50% or more undervalued, I'm going to grab Target, Hershey, and Nike. I could do Nordson here, but I think I'd rather, instead of doing a 5% allocation to Nordson yielding 1.6%, I think I'd rather, do 10% into either Pepsi or ADM and get a little bit higher starting yield. Since I am 42 to 53, 1.6% starting yield's not as appealing at that point in tier 3, but overall, that's the breakdown, you guys. Let me know if there's anything amongst this group of stocks that you're adding to, or if there's any other ones that I think are overpriced that you actually think are a bargain. Let me know in the comments below. Thanks for watching. I'll see you next time.